Good morning. It's a beautiful day, and this is Michael with MoneyStream Financial Solutions and the MoneyStream Solutions team at PRMG Mortgage. So I want to take a minute and talk about interest rates, mortgage interest rates. Probably by now you've heard that mortgage interest rates are at all-time lows. The 30-year conventional rates hovering around 3%, the 15-year maybe 2.5%. In that range, plus or minus an eighth of a point. How does that happen? And how do you, if you're going to refinance or purchase a house, how do you make sure you get the very best possible rate? And we've all heard from time to time about the Fed lowering rates. And many times people think that means exactly the Fed lowered the mortgage rates. But that actually is not the truth. That's not accurate. Mortgage rates come from the mortgage bond market. Mortgage bonds or mortgage-backed securities are just a bond. Bond is a form of debt. They're bonds backed by mortgages, mortgage-backed securities. It's amazing when they name something appropriately. So what moves mortgage rates? What moves bond rates? The bond market in general. The biggest thing that moves the bond market is inflation. If there's inflationary pressure, bond rates are going to drop, mortgage rates are going to go up. Very simple. Why? Because bonds tend to be long-term debt, and if there's inflationary pressure, you don't want to be locked in a long-term debt if you're an investor. So you're looking at short-term, they call it a flight to quality. So when the stock market tanks, the stock market goes down, bond market goes up, there's a flight to quality. When the bond market goes up, that means the return on bonds is higher. Mortgage rates tend to go down. And that's more or less what's been happening. Some of this is artificial over the last year and a half. Some of it's artificial because the Fed has been buying bonds, and it's their job, but they're artificially manipulating the interest rates to keep them low, to keep the real estate market moving, because the real estate market is one of the biggest driving factors in the economy. Home construction, new home sales, refinances, things like that. So here's my, prediction. If I pull out my crystal ball, I'm going to predict that in a year or less, we're going to see mortgage rates trending up. And the reason I believe that is because the federal government has put a few $1 trillion into the economy in the way of bailouts, but they've incurred that debt. And when that happens, it does tend to increase inflationary pressure. Inflationary pressure is enemy to mortgage rates. So as we start to see that inflationary pressure manifest itself, you're going to start seeing mortgage rates go up. So my recommendation, if you're sitting on an interest rate above 3.5% or 4%, give me a call and let's talk about the benefits of possibly refinancing. We can run through some scenarios and see if we can lower your payment, maybe shorten your term, and improve your overall situation. If you're thinking of buying a house, I recommend sooner than later, because right now mortgage rates are at an all-time low, and you're definitely going to want to take advantage of the additional buying power that you get in the way of those low interest rates. So give me a call, 407-732-0110. Again, 407-732-0110. Or come check us out at MoneyStreamFinancial.com. Have a great day, and happy Tuesday.